Okay, go for it.
Thanks, John.
You're welcome.
Okay, so I think we were talking about the airline miles. So airline miles, if you have airline miles that you can use, you have no cost in those airline miles. And so for business, they're not deductible. And so my recommendation is always to use your free airline miles for personal use, and then go ahead and pay for your business travel, right? The business travel, when you use those will be deductible. And then another question came up about gifts. And so the gifts that you give, they are limited to $25 per person per year. And so you either, if you give a $30 gift, you can deduct $25 and not the other $5. So you might want to, look at what gifts you give and come in within that $25 limit. So and that restarts the calendar year. January 1 starts the new year.
Would that also be for customers as well?
Yes, they are considered a client. You call them customers. I'll use client and customer interchangeably, but same thing. Mm-hmm. And then the other question is, you contribute to the foundation. Mm-hmm. Is it the Unique Foundation? And so that those charitable contributions are not a business expense on your business schedule, but there are personal expenses and itemized deduction on Schedule A. If you itemize your deductions, that's where you deduct them. Okay. All right, let's talk a little bit about mileage, because mileage in your type of business can be a large non-pocket expense that can be written off. So on mileage, what you do is you can either claim your standard mileage or actual. So I generally recommend taking the standard miles, and to be quite honest with you, this year I don't know exactly how much it is. It's about 55 cents a mile, but it changes every year, and I just have to look that up. But go ahead and Google it. You can Google it online, and they'll tell you for 2017 what the mileage rate is. So you need to track your business miles, though, regardless of whether you use the standard cents per mile or if you use your actual expenses. So you can actually track your insurance, the gas, the repairs and maintenance. You can do what's called your taxpayer will depreciate the cost of your vehicle over a period of years. But if you don't want to keep that extra additional information, just track your miles. So at the beginning of the year, what you want to do is, if you don't have your beginning odometer reading right now, go take a look at your car, write down the miles, determine about how many you drive per week back into January 1st of this year. And once you're back into January 1st, then you'll have your starting miles for 2017. And then, before you go out every year and you celebrate the New Year's, look at your odometer on your car, write it down, and you'll have the ending miles. And then from that point forward, you'll always have your beginning and ending miles. So you'll know how many total miles that you drove, and you can deduct the number of business miles that you drive. So the question comes up is, what miles are deductible for business? And it depends on whether you have an office in the home or you don't. So the benefit of a home office is not actually the home office expense, but it's the mileage. So we'll talk a little bit later about a home office, but if you have a home office, you are considered, every time you walk out your front door, you're considered en route for business, and you track and you just pick up a mileage log, or they have a lot of apps for mileage. So yeah, you're shaking your head, and so that's a very convenient way. And you just log in, where it is that you went, and you track your miles, and at the end of the year, you know how many miles you drove for business, and take those numbers times whatever it is for the year, about 55.5 cents a mile, and you have your miles. If you don't have a home office, then every time you leave your home, your first stop is considered a commute mile. So if you run up to pick up some supplies, those, and run right back to home, those are non-deductible, non-business lines. Okay, so that's a really important distinction. But for those of you that don't have a home office, when you leave your home and you go to that first, let's say it's an office supply store. Once you're there, then anywhere you go after that on business, those are deductible business miles. And then your last stop to home, non-deductible commute miles. Is that clear?
Yeah.
Within? Okay. Okay. So if you have a home office, definitely take advantage of those extra business miles. Let's see. A question was asked about sharing costs. So some of those costs that you share are maybe a shuttle when you're traveling, or brochures. You possibly order in bulk, and then you, okay. Okay. The cost, okay. All right, so on that, what you want to do is, there are costs that you won't get a receipt. Uber driver, a shuttle driver, and what you do is you just, and some of those are cash payments. So you just take out a piece of paper and write down what it is that you have, the date, what it was for, how much it was, and then you put that in your business records as a receipt. Okay, then it's logged. Okay. And then the other is if you share, let's say you there were catalogs that are purchased, one person would be ordering the catalogs, paying for the catalogs, and then the other presenter would then go. The presenter would then go ahead and repay. And so my recommendation is going to be for the presenter that purchased and paid for the catalogs to go ahead and copy the invoice, submit it to the person they're sharing the cost with, write a note on it that their share is 50%. That presenter then write a check to the one that paid, and that's your receipt. So that can be done. That's no problem.
We also have a system that's a paper, so they give us a purple debit card. So what I do is we try to keep all of my transactions through that, and we are able to transfer funds from one presenter to another within that.
Oh, perfect. Yeah, that works. Yes, and then you just want the invoice from the presenter so that you can have the invoice for your receipt. Let's see, meals and entertainment. Meals and entertainment, they're 50% deductible. So I mentioned the additional reporting requirements, the record-keeping requirements, but anytime there's food present, the general rule is it's going to be limited to 50%. So you should have an expense category that has meals and entertainment, everything 50% deductible, and when the return is prepared, that's when the 50% is reduced. So provide your tax preparer with a full amount, 100%, and then the preparer then reduces it by 50%. Okay?
Now, say because a lot of times I'll have a team meeting at my house, or a Christmas function or something. I buy the food and include that. Is that different as far as meals and entertainment? Yeah, so with the meals and entertainment, it's a little bit different. So there is something called a business meeting, and that's 100% deductible. In that business meeting, sometimes there's food. There needs to be a written agenda for the meeting, and then as long as you keep the agenda, you can write off 100% of the meals. And you should keep a category called business meetings. It won't go in under meals, but it will go under business meetings. Okay? And that's how you'll distinguish between those two. Let's say, though, that you ever have home parties where there are a group of, so if you have home parties and you bring food, that's 50% deductible, not 100% deductible. Okay? And then what category would that go?
Meals.
Okay.
Yep. Yeah. It is. Okay, let's talk a little bit about home office, and then kind of some of those expenses that they're personal and their business, or like your internet, your cell phone, maybe your computer, a printer, things like that. So what happens is you use them both for business and for personal. And so you can't write off 100%. But what I do is you track 100% of the costs. So track all of your cell phone use, all of your internet costs in separate categories. And then at the end of the year, you just need to kind of do a look back and say, this past year, I spent probably 80% of my time on my business, on my phone for business. And then you apply the 80% to your phone. You do that with your internet costs, and if that is, you have others in the home using the internet, so maybe that's a little bit lower, and let's just say 60%. So there's that look back, and it's your best estimate, with a guesstimate, and that just apply that every year. Okay. The computer, you'll have business and personal use, and you can actually allocate the value of the computer or the cost if you owned it prior to starting business, or the cost of the computer if you buy it once you started business. Then those are things like toner cartridge. If you have a printer and you use it 50% for business, you're going to take the toner cartridge at 50% as well. Okay, so there are a lot of those allocations when you have a home office, and you just do the most reasonable estimate. Right? Then home office. So those are not considered home office expenses. Those are just considered business expenses that have a personal and business allocation to be done. Your home office, if you rent, you can write off your rent, renter's insurance, and the utilities. If you own, you can write off a portion of your mortgage interest, the real estate taxes, homeowners insurance, homeowners association dues, the repairs and maintenance that apply to the entire house that would also benefit the room you use for the office. And you do that based on square footage. So you take the square footage of your office divided by the square footage of your home, and that percentage is then applied to all of those costs that I just mentioned. So for a home office, from a tax standpoint, they always say exclusive use. And, exclusive use is literally exclusive use. I'm going to tell you in practice, it's hard to meet exclusive use. And many home offices, I would say, if we were really being honest, they don't need exclusive use, but they are used primarily for business. So, for instance, if you pay your personal bills on a computer that's in your home office, you've now used it for personal use. But, these are things that happen all the time. So that exclusive use, you're going to just need to talk to your tax preparer and just, let them know how you use your home office and such. So that exclusive use is important. In practice, I don't think that it's truly exclusive use, though. So you can't use a portion of a room. Let's say your dining room. So you can't say, well, I'll use half my dining room. It has to be a separate room for the home office. The one thing that you can do is for your inventory. If you do have inventory, some of you sound like you do and others don't. But you can use a closet in another room off of your home office and off of the area that you designate as your home office. And you can also include that in the square footage. Okay, and it needs to have just the inventory stored. So any questions on the home office? No? Okay.
Unless, Sean, has anybody said anything?
that sound okay? All right. Okay. So then the other items that I think are really the ones where they sort of have a little bit more to them, and that is sales and purchases, how you receive your 1099. What if you sell? What if you buy direct and then resell that? Okay. So there are there's within just these categories, there's a lot of information, different ways to do it. So it's really, you need to know how you do it. It applies to you, but there's kind of the basics of it. So I think I understand that most presenters sell, and the customer goes directly to the website, orders, and then the presenter receives a commission from those sales, correct? Okay, all right. So, and that is then reported to you by the company on a 1099 form, and so that's real easy. They track your income. You also receive prizes and awards.
So you get, like incentives and
Okay. So those incentives, are those included in your 1099? Do you know? Okay. And at the end of the year, do you receive a summary that shows what your incentives were? No. Okay. Okay. So most companies, what I find, a similar type of businesses, is that in the 1099, it's just the commissions, and then there is an annual report that also shows what the incentives were. And it's really important if those incentives are at retail value, which typically they would be, or wholesale value, because there's I think some of you may receive those incentives and then resell. You can resell, correct, as their product.
Some of them are. Yeah.
Okay.
Summer trips.
Carly, are you talking about trip incentives or like bags and stuff like that? Because our trip incentives are included in your income for the year on your 1099.
Okay, I didn't know that.
Yeah.
On the 1099 they are?
Just the trips, not the other stuff.
Okay. What about, so the incentives, are there ever any products, makeup products that would be sold?
That we get as an incentive? No, not really.
No? Okay, then I don't need to talk about that.
I mean, sometimes we'll get like a bag or something like that. Or, yeah, I mean, from the company directly, no. But from the leaders will sometimes give, do perform at X level and you get this product as a gift. Okay, so those come between you, not from the company. Okay.
Yeah. All right. So there are some things we don't need to talk about. So it seems like you sell a couple different ways, directly from the website, or some of you order and have the inventory shipped, the product shipped to your home, and then you sell direct from that product. Okay. To save our customers shipping. Okay. All right. Okay. So in that case, do you pay the sales tax to corporate? Okay. So let's see. There are a couple things there. So you pay the sales tax when you purchase. But most states, and we're in Arizona, so Arizona is absolutely one of those states where you would then, as a business owner, be required to have a license, a sales tax license, and you would then be required to collect tax from your customers on those sales. You do. So you personally, you as a business pay those, and then corporate pays for those sales that go directly through them. Okay, perfect. Right. So one of the questions is, do you report your sales with the sales tax included, or do you report your sales net from sales tax? And you can report it either way. You just need to be consistent. So if you include in your income, the gross income, your products, the amount you actually receive from your customers, income, sales income plus sales tax, that's the gross income. You also then want to deduct the sales tax you pay because it's included in income, so you want to deduct the expense. If you report net and you report only sales minus and not include the sales tax, then do not deduct the sales tax because then you would be taking a double deduction. So either one is fine. It's just that you want to get a method and stick with that method and stay consistent. Okay? All right. All right, so some of you will need to track inventory because you purchase and then you resell. So that's something that does your software from the corporate. Okay, so most of this type of software, they don't account for inventory because that's not how they sell. So what I would recommend is that you use something like an Excel spreadsheet, or you can do it by hand. Excel is real easy. I think Numbers is on a Mac, and that works just like Excel. And you just need to log your inventory, so you have a separate Excel worksheet, and you just track and that inventory to you. The question was, do you report that at wholesale or retail? You report it at your cost, which would be wholesale, right? So you are always selling. Your cost is what you paid for the product, and that's what you track it for. So you would have, like on Excel, you'll have you'll list the date that you purchased the product, what the product was. If there were 5 of them, you'll list how many, and then you'll list your cost for each individual item. And as you sell them, you will then remove them from your inventory list. So that's a really active worksheet. You need to continue to go back, and you need to locate the product. So for inventory, this sort of gets really kind of accounting-ish. So there's something called first in, first out, or last in, first out. And so once you select an inventory method, you need to stay with that method. And I'm going to say, if you go back, let's say you have product purchase January 1st of 2016, and every time you sold, you removed your product from your inventory sheet from January, right? You'd want to sell your oldest inventory last because it's you want to move that product first. Yes. Mm-hmm. And so you would be using the first in, first out method. And so on your inventory sheet, you would just simply go back to January 1st. You sold 3, give me a product, 3 mascaras. And then you have, at the end of the year, you would also know how many are still on hand in stock. So you now have inventory. So many of you probably do ending inventory, track ending inventory. Okay, let's talk about ending inventory. So that Excel worksheet, if you set it up properly, you can actually, at the end of the year, just very quickly, to some columns, and you'll know exactly what you have on hand. But for those of you who are just closed the 2016 year that do not have that information, you need to do the physical inventory, which is, right before you go out and log your mileage December 31st of every year, you also count the inventory before you head out for the night. And what you do is you just go into, let's say, that closet of your inventory, and you just count what you have. The problem with the count is, did you pay $5 for that mascara, or was there a price increase and not the $6? So if costs are real consistent, that's not much of a problem throughout the year. But for those of you with inventory, keep the Excel inventory sheet separate from your accounting software. Track it in detail at the end of every year. December 31st, you're actually going to calculate what you still have on hand. So do what I call a hard close, and you will actually. The question was asked: you account for that at cost, your cost, wholesale or retail. Your cost. That's the cost, and then your ending inventory, whatever that is. Let's say you've got those 5 mascaras. How much is a mascara at cost? At cost is $29. Mm-hmm. Okay, 5 mascaras, $29 a piece. That's your ending inventory for the year. That's what you have on hand. And ending inventory is important because you can't write off the cost until you sell the product. So you match cost with revenue. So quite often, I have clients that they put all their profit back into buying product, and they forget that they're going to be paying tax on their profit. So just for a cash flow purposes, make sure at the end of every year is that you keep some cash on hand to pay your tax, rather than purchasing a lot of inventory. Let's say December 15th, you purchase a lot of inventory that you're not going to sell by the end of the year. You're not going to be able to write that off against your income, okay? Because it's the matching principle. Okay, does that make sense? Okay. So that's kind of the inventory and sales piece. You'll also, do you ever purchase products as samples? Okay. And do they come in different sizes than the regular purchases?
Now they do. They just use that option, but before we would have to just buy the regular product and use it for the options.
Okay. So then when you purchase product for samples to use as demonstration and to use on your customers, those are supplies. So right off the cost is supplies, right? Same, the brochures and catalogs that you buy, those are supplies. Write those off as marketing. And then the products that you purchase to use for yourself, my position on that is that they're non-deductible personal expenses. So not all preparers will have the same interpretation of that, but it's like, so let's say clothes. I'm in a dress. I've never worn this dress outside of the office. But I can't write off my dress that I wear to the office. It's part of my kind of uniform. Makeup is something that someone would incur as a personal expense and use, whether they were in the business or not. So from that standpoint, my position is it does not qualify as a tax deduction. Okay, but talk to your preparer and ask for the interpretation. You know, a lot of these recommendations and such, with who you work with for your taxes, what I'd like for this to be is more kind of giving you some information, kind of get some questions going in your mind, and then talk to your tax preparer, because your tax preparer, everyone's situation is a little bit different, and it may be that it qualifies, you qualify, someone else may not, the way that they do that. So that's something, just because I said it wasn't allowed or it is allowed, and maybe the way you do business, your preparer considers it either allowable or not allowable. You just need to, you'll have the information at least to ask the questions and ask why is it allowed to do. Okay.
And for that, Cyndi, just to kind of expand, the one girl specifically who asked that, she's one that will go out with just, half of her face done, or only one lash done as like a demonstration.
Yeah, I think that's a great idea. Yeah.
So still would not.
I still say no. Right. But all right, then let's see. I do want to come back to that profit motive. So I want to circle back around. At the very beginning, I mentioned that to be in business, you need to have a profit motive. So some sales are made. If you make a couple sales to family and friends at cost, that's one thing. But if you make most of your sales at cost to family and friends, I would question whether you had a business or not, because you have expenses to generate that commission. And if you're selling at cost, you don't have a profit, you cannot write off expenses and then have a loss to write off against other income. Okay, so that would be something to talk to your preparer about, as well as when does it kind of cross the line, what expenses are deductible. And if you sell some product at cost and some for profit, I would say to kind of bifurcate your business into expense, only write off the expenses where you incur them to generate profitable sales. Okay. All right. What questions have I missed?
I know one of the girls had questions because occasionally we do fundraisers for people and either donate product or a portion of like our parties.
Okay.
Because the party hits $200 in sales and we do 10% and 3 products back from those products as well as our commission. So a lot of times we'll then take that back to someone in the community or something like that. They were serious about that and how that might count for charity or.
Okay, let's see. So for charity, for a fundraiser, if you donate product, that to me indicates that you have to go out and purchase it on your own. And so possibly some of you that are doing this, you've got the product and it goes into that Excel inventory sheet, right? So once you donate that for a fundraiser, what you can write off is the cost on the product. Not the retail value and what you would have made if you sold it, but just simply the cost. But don't forget to take it off your inventory worksheet. Otherwise, you don't write it off. So, and then anytime you remove something from inventory, remember if inventory is spoiled, you've had it on your shelves too long, you need to remove that from your inventory sheet so that you can write it off as spoiled product. Okay, and that can be done.
Can I ask a question? Do you mind?
Yeah.
Most of the donations for a fundraiser are commissions, a portion of commissions. It's not necessarily product. Mm-hmm. We're not heavy on inventory at all. But what do they do if it's a donation of a portion of commission? You know, say they make 25%, they might be donating 10% back to the foundation that they're raising money for.
Right. So I say it's kind of is unfavorable. You have the sales commission, the income, right? And then any donation to a charity, it's not a business expense, but it goes on.
It'll go to their personal taxes. Okay.
Personal taxes, Schedule A.
Perfect.
Always Schedule A. Charity is always.
Perfect. Mm-hmm. Thank you.
But then if you were donating, say, like a product basket to like a fundraiser for, like a silent auction or something, would that be the same thing or how?
Yeah, your product, you can write that off right on your business schedule.
So that would stay even though it was donating to charity. Okay. Mm-hmm.
Yes. Yes. I think one of the other questions was about if someone doesn't receive a 1099 because it's under the $600 is the requirement for earnings. Mm-hmm. You still have if you have a business, you still report it. You don't need a 1099 from the company, them telling you how much you earned. You have the requirement to track that in your accounting software separately, and then you go ahead and report what you did earn. If you sold product on your own, that would certainly not be on the 1099 form to you, and then take your business expenses as well.
And that's good to hear because I know some of the leaders have told their girls don't even ask questions because you don't even earn that much. And so I think that's good for them to know that even if you're under that level, you can still.
Yeah, absolutely. You still, any dollar you earn, they want the tax on it. They want to know about it. I do want to circle back to that profit motive. And so for some of you who are saying, gosh, I really kind of buy and sell to family and friends, don't have that profit motive. So what do you want to talk to your tax preparer about? And that's a hobby. And if you have a hobby, that's very unfavorable, you report all of your income, your gross income. And then on the front of your tax return, and your business expenses, because you will have some business expenses against income, It's an itemized deduction. It's subject to a phase out. And so for most people, you first need to itemize. If you don't itemize, you don't receive the benefit of any expenses. You're just paying tax on the income itself. And so I would say if you're in that camp, you want to look to see how you can make some changes and get that back over to reporting it as a true business. Mm-hmm. Let's see. I'm reviewing the questions to see if I missed any. I think that's it. From these questions, do you have any questions after here? No,
I don't. Sean, has anyone typed anything? I'm not sure, because I know I had said that we'd open it up for Q&A at the end.
Mara said, Carly, we get the inventory right. Since it is shipped to us, it won't reflect on our taxable income, the 1099 from corporate. Do we still declare on tax time?
So I think if I understand the question correctly, so they do report the sales, right? They report their sales on the inventory that they sell, and they also report the cost of their inventory on the tax return. And they also report any expenses that they incurred to sell their inventory, that type of inventory. Does that answer the question?
Mara, I don't know if you can unmute yourself, but basically what I think she's asking is when we make a personal purchase or we just make a purchase, we are making it. It doesn't reflect on our 1099. So she's saying the stuff that's personal is not write-off, but then the stuff that if you asked me to purchase you a collection that was $100, yes, that gets declared.
Absolutely.
Is basically what she's asking.
Absolutely does, yes. Mm-hmm.
Yeah. Yes. And when Unique issues the statement at the end of the year, they separate our personal purchases versus that. So I think she was just looking for confirmation.
Oh, okay.
Yeah.
Mm-hmm.
Yeah.
That was the only question, Carly. Oh, shoot. Sorry, guys. Sorry. She put okay, thanks.
Okay. Yeah. Okay, perfect. All right. Oh, perfect video singing. All right. Anything else? No other questions, Sean? Anybody else?
No other questions.
Okay. Perfect. Well,
Okay. All right. Yeah. Okay. Well, thank you. I hope that was helpful, and hope that helps you gather your tax documents for 2016.
Well, and that was the big thing too. Is some of the girls were nervous about what to take to their tax appointment. What to recommend? Do they bring in? I know the answer, but do they bring in all of these receipts and just throw them at you? Mm-hmm.
Yeah. So you have an accounting software that will print out the income and expenses. So it prints out the profit and loss statement. That's the summary statement, and that's what we work with. There's a lot of additional information that we assume you have no questions on what went into preparing your statement unless you ask. So just bring your questions as well, and make sure that what's included on that statement you can deduct. And if there isn't something there like your internet, your personal internet, your cell phone, if you don't track those, then those need to come in separately and just total for the year rather than receipts.
Okay. Yeah. Saves a lot of time because otherwise it's very costly.
Right, exactly.
To go through every single receipt.
Exactly.
Any of you girls on live have questions? You can type them. I'm watching.
And that's the other thing too. You prefer that they ask you questions instead of being quiet and then later regretting that something wasn't said. I know some of the girls are so intimidated to go to these tax appointments and to look quote unquote stupid by asking a wrong question.
Okay. So ask questions. Sometimes we don't. So what I do when a client comes in is I always ask, what questions do you have? Right? And I listen to the questions and then I answer the question. And then I answer the questions that they didn't ask. Okay? So you don't know what questions you should ask, but if you ask some questions, it helps and gives me an indication of sort of where your knowledge level is and what you may be doing correctly, where you may need a little bit more guidance during tax season. So there are different types of preparers. Some preparers, you just send your statement. They don't ask you questions. You don't even see them. They don't ask you. You don't ask them. I always think it's good, especially starting out, to meet with your preparer, to go through some things, just to have a dialogue on the business, and even ask, just tell them, this is how I do it. Are there recommendations? And see what feedback they can give to you. Yeah, but I would say, want to go to a preparer that
Christine has
speaks for you. Okay. Yeah.
Carly, Christine Hunt has a question. She put I'm trying to read this hang on one sec. I gotta take this out of the thing so I can read sorry. She said, so your bulk orders count, not just my own personal purchases for myself, correct? Yes, that's correct, right?
Yes. Yeah. So she places bulk orders for the customer.
So, Christine, what she was saying is basically you just keep a running log, like an Excel spreadsheet or numbers, whatever computer program you have, on what your inventory in and inventory out is. You're welcome.
Yeah, so, and you'll only track those products that you purchase and then resell direct. But if they order from the website, then there's no need to track any of that.
Sorry, my computer's loud. Okay, that's it for live. There were no more questions on live so far.
Okay, good. Well, I think that's it. We're wrapping up in an hour, so perfect.
Okay, great. Okay, thank you.
All right, thanks, guys.
Thank you for your help. Thanks, Carly.
Bye.
Okay, bye.